For as long as most investors can remember, US long-dated treasuries have been the safe haven asset of choice. But things are changing. US fiscal policy has taken a new course, and US debt levels are at their highest level since the Second World War. Joining me today is Kevin Cousins, Head of Research at PSG Asset Management. So Kevin, maybe to kick us off, you can explain to us why US Treasuries have been the safe haven asset of choice.
Morning, Audrey. If you look over the last 40 years, we've had this fantastic bond bull market with rising bond prices and consistently declining yields. So normally when you buy insurance, you have to pay. And in this case, actually, the insurance has paid you. So it's been free insurance. And then the second thing is in periods of economic volatility or market stress, that's when you want your insurance to deliver. And the US long bond has done a fantastic job of doing that. If we dive in and just ask why it's been like that, you know, Alan Greenspan joined the Federal Reserve in 1987. And since then, every time there's been a bit of market stress or economic stress, you could rely on the Federal Reserve to ease rates and either cut rates or engage in QE in more recent times. And the asset most geared to that action was the US long bond. So it's done a fantastic job. If we look today, once again, people are worried about the economy. And the Federal Reserve Bank of New York's forecast is for a recession with a 60% probability within 12 months. And people are reaching for the US long bond, the safe haven asset of choice. And in fact, it's hugely over-owned by global asset managers, indicating they believe it's still going to perform its role.
So for over 40 years, US bonds have been the safe haven asset of choice. So why should this time be different?
Well, let's get it right. It's sort of 38 years because of what happened last year in 2022. You'll remember that equity markets were off quite sharply. So between January and September, the S&P 500 dropped some 16%. And over that period, the US long bonds total return was minus 36%. So instead of being the safe haven in your portfolio, it blew it up. It was dynamite. And the reason we think this happened was because we've moved into an era of fiscal dominance. This is where the fiscal position of the US government has overridden the monetary policy response. And a good measure of fiscal discipline is to look at a twin deficit, so the current account deficit plus the budget deficit, and track how that moves over time. And normally, an emerging market, you'll see a wide twin deficit with a lot of volatility. But if we look at the charts over the last few years, and you put up the US and you put up South Africa beset with our political and macroeconomic problems, you'll get which one's the emerging market wrong. Actually, South Africa's been the disciplined player in terms of fiscal policy.
Wow, that's a really interesting point. So are you saying that South African bonds are actually lower risk than US bonds? That seems like a very controversial point to be making.
Okay, maybe that's a bit provocative. But if we look over the last 3 years, South African bonds, total return has been plus 12% in US dollars. So they protected your capital and given you 12%. US long bonds total return has been minus 38% over the last 3 years. So they've detonated in your portfolio rather than providing a safe haven.
Okay, but US yields have been much higher recently. What does that mean for investors?
Yeah, you raise a great point. In markets, you've always got to look forward rather than backwards. So the question to ask is, are the macroeconomic fundamentals priced in with the current yield? And unfortunately, our research shows that's not the case at all. In fact, contrary to that, the yields need to go a lot higher. And there are several reasons for this. So firstly, the Congressional Budget Office, the CBO in the US, does long-term budget forecasts, and they show the primary deficit is going to stay wide and accelerate in the future. And the key driver of this is demographics. The baby boomers are retiring, and that means that Social Security spending and Medicare spending is going up very rapidly. Now, you know how polarized politics is in the US, but there's one thing that the Democrats and Republicans agree on, and that is that you can't touch entitlement spending and you can't touch defense spending. Unfortunately, those are the two key aspects in the budget, and you can't cut the deficit unless you reform those. So the deficits are here to stay. The other thing the CBO show us is that the level of debt is over 100% of GDP, and it's only been there once before in World War II, and is forecast to go up very rapidly from here because of the wide deficits. Now, the CBO's forecasts are actually too optimistic in our opinion, because they assume that the interest rates paid on that debt remain fairly low, and we see a lot of pressures that are going to move those rates up. So the level of debt and the deficit are going to go up much faster than they project, we believe. The other aspect is the amount spent on debt service by the US government is going up very rapidly between the rise in debt and the rise in interest rates. So they're caught in what we would call a negative feedback loop. The worse the deficit is, the bigger the debt outstanding, and the higher the rates, it feeds back on itself, as it were. The other issue is that if you're managing a country or even a company's balance sheet, you need to ensure that your maturity profile is relatively smooth. And what I mean by that is you don't want a whole lot of debt to mature in a short period of time, and you need to roll it. You can sort of flood the market, as it were. For whatever reason, the US government has neglected to do this. And over the next 2 years, half of the total debt outstanding needs to be rolled.
Sure.
So if you look at the total funding requirement that we're talking about, that half of their debt is about $12.5 trillion. And then if you take the deficits over the next couple of years, it will take the total to $17 trillion that they need to place. To put that in context, it's 63% of their current GDP. If you take South Africa, for instance, we need to fund 15% of our current GDP, so less than a quarter of the US over the next 2 years. Then the final issue is who's going to buy this $17 trillion? If we look at existing holders of US debt, Japan has not increased its holdings for many, many years, and in the last 2 years it's seen their holdings decline. China's been consistently net sellers, and the only entity left that has been buying is the Federal Reserve. So you really need to anticipate that the Federal Reserve will be the buyer of last resort.
So tie it all together for us, Kevin. Some great big moves happening. What does this mean for investors?
Yeah, so when we engage in macroeconomic forecasts, you've got to be very humble, because of course we don't know what the future holds. So our approach is to think in scenarios and in decision trees and try and apply probabilities. One of our macro research providers, Louis Gave, showed us a very interesting decision tree based on this question, that pivots around this question, whether the Federal Reserve will monetize debt or not. And as we've explained, we see a significant probability that that's the only way they can place this $17 trillion. And that's really important for what is the safe haven asset. Because if they do monetize debt, that environment is a very weak dollar environment. It's an environment that gold does well. It's an environment that commodities do well. And it's an environment that emerging markets that are commodity rich, their bonds do well and currencies do well. And those Louis Gay believes those are the new safe haven assets, as it were. Now, we don't disagree with his conclusions, and we see a significant probability that they will be very effective safe haven assets.
Kevin, that's been a really thought-provoking chat. Thank you so much for taking the time to talk to us today.
My pleasure.